Hello, this is Maria Olson, and I'm joined with Heather Hirsch and Grant Thompson. We're going to go over a case analysis for Olympus Imaging. And their background is that they're an international company that sells cameras and medical equipment, and their corporate headquarters are based in Japan. The officers who ran the company in this time period were Toshiro Shimoyama, the CEO in 1998, Hideo Yamada, the corporate auditor, Kiyoshi Kikukawa, who is the chairman of the board of directors, Hisashi Mori, executive vice president, and Michael Woodford, the president. The slippery slope that began this case was an increase in the value of the yen, which led to a decrease in exports. That resulted in them using a financial engineering technique known as Zaiteku, involving risky investments leading to a total losses of 100 billion yen. This all took place over a 20-year timeline.
In 1998, there was a change in the law that forced Olympus to change from a Japanese accounting standard that allowed assets to be valued at historical cost to IFRS, where they had to be valued at fair value. At this time, Yamada and Mori realized they were going to be forced to reveal the level of impairment. At this time, Yamada and Mori came up with a loss separation scheme. This scheme was okayed by Toshiro and involved setting up shell companies in the Cayman Islands. These shells, Central Forest, Easterside, and Quick Progress, were helped set up by Axis Japanese Securities and involved the transfer of impaired assets at book value to get the complete losses off of Olympus's books.
The accounting entries made to transfer these impaired assets off their books can be simplified down to a discrete transfer of cash from Olympus through a bank intermediary to one of the shells, followed by a purchase of Olympus's impaired assets at book value instead of fair. Consolidation could have canceled this out, but that wasn't their intention. After getting the impaired assets off their books, they had to find a way to pay off the loans made to the shells. This started their loss disposition scheme. This involved purchasing startups and other entrepreneurial ventures at inflated prices that resulted in goodwill, along with massive advisory fees in order to hide cash going out to pay off the shell loans. To illustrate the transactions between Olympus, third parties, and startups, you can see how this arrow to this one, to this one, to this one, and on made it so complex that auditors didn't follow through to find fraud.
Some of the auditors' problems were that they believed Olympus was just flexing muscle by purchasing these companies and attributed it to cultural differences, which is why they didn't question their behavior for a number of years. Finally, KPMG didn't agree with their overvalued goodwill and in 2009 and 10 forced them to take an impairment charge. This was basically writing off losses for Olympus. The finale in the disposition scheme was the purchase of Gyrus. They put an extraordinary advisory fee on the Olympus's books under the records of this company and used that money to finish paying off bank loans used for the funding of the shell companies. This disguised 62 billion yen of losses represented as goodwill. "You're fired," is what Olympus said to KPMG for questioning their treatment of their merger and acquisition fees for Gyrus. They then turned around and hired Ernst & Young as their new auditors in 2009. Sadly, they allowed them to take $177 million to be booked as goodwill on this acquisition.
Michael Woodford, the whistleblower. He was the first ever foreigner to be hired in upper management for Olympus and was therefore an outsider to the culture. He was brought on as CEO to help with the impairment issues, but immediately started questioning the extreme advisory fees. He was fired after not agreeing to go along with the scheme and became the first ever CEO to whistleblow on their own company. The fallout. In 2011, Olympus was forced to create a 6-man committee to investigate the scandal. Their stock price plummeted by 70% in 3 weeks. They managed to avoid being delisted by the Tokyo Stock Exchange, and they had to file 5 years of corrected financial statements. Suichi Takayama took over as CEO and president in November 2011. Punishments. The firm paid a $130,000 fine. Kikukawa was sentenced to a suspended 5-year sentence. Mori received a suspended 4-year sentence. Yamada received a suspended 5-year sentence. And the lax punishment is due to the lack of evidence that the individuals themselves received any of the money from the fraud.
In Japan, honor, pride is the core of their cultural beliefs. This belief system led the main participants in this very complex fraud to hide losses in order to preserve the name of Olympus and protect their loyalties to their company and their CEO, Kikukawa. The auditors did not uphold the professional auditing standards throughout these years. They did not question high-value transactions and advisory fees that were obviously excessive. Ernst & Young did not follow up properly with the previous auditors, KPMG, about their differences in opinions with Olympus. Now, onto the specific auditing standards.
Auditing Standard AUC 510.07. This standard states when previous financial statements were audited by predecessor auditors, auditors should request from management to authorize review from previous auditor and then fully to respond to inquiries, therefore providing information to properly plan the engagement.
KPMG failed in regards to auditing standards AUC 240.29b and 240.a6. These state that auditors should evaluate the application of accounting policies, particularly those related to complex transactions. And point A6 states that engaging in complex transactions is a characteristic of fraud.
Auditing Standard AUC 240.12 states that the auditors should maintain professional skepticism throughout the audit, recognizing the possibility that material misstatement due to fraud could exist. These auditors should have treated these exorbitant acquisitions and advisory fees with more professional skepticism, as well as the initial movement of assets off Olympus's books.
This is just the tip of the iceberg for the Olympus fraud. A large portion of Olympus's money was missing from the statements, and it was never discovered where it went. But it is highly speculated that Kikukawa was making payments to the Yakuza, the Japanese mob. What for? The world may never know.